The Telco Stablecoin Thesis. Why the next banking network will not be built by banks. Summary statement. The future of global payments will not be dominated by banks, card networks, or fintech apps. It will be built by mobile network operators who already possess the strongest distribution, last-mile identity verification infrastructure, and political licenses to operate. Telcoin's model reveals that stablecoins will scale not through crypto-native adoption, but through telecom-native settlement. This means SIM-anchored identity, mobile money wallets, and telecom-led float pools backed by government securities. In this architecture, the liquidity lake, also known as EUSD, sits at the center, fed by global on-ramps and drained by telco-led cash-out points, while token incentives, known as TL, create a moat no traditional stablecoin issuer can replicate. The result is a parallel banking network. It is faster, cheaper, and more pervasive. It is emerging beneath existing rails and quietly shifting monetary power from banks to telcos. Section 1. Introduction. The hidden power in your pocket. When people talk about the future of payments, they point to banks, fintech companies, or blockchain startups. Very few look at the most obvious players already embedded in every economy. These are mobile network operators. Banks hold deposits, Visa processes cards, fintech companies build sleek interfaces. But only telcos combine near-universal distribution, government-blessed regulatory licenses, SIM-based identity, constant access to billions of people, a dense physical cash-in and cash-out network, and embedded trust, because the phone is the most personal device people own. This combination makes them the natural foundation for the next global money system. The Telcoin architecture exposes this with startling clarity. What emerges is not a crypto payment app. It is a blueprint for a new banking system that grows from the edges of the mobile network, not from bank branches or Silicon Valley apps. Section 2. Why banks cannot win this race. Banks face deep structural limitations. First, legacy infrastructure. Banks rely on mainframes, batch processing, and multi-day settlement. Second, regulatory drag. Every expansion requires approvals, reporting, and compliance burdens. Third, poor distribution. Most banks have no reach in rural or low-income regions, which are the exact places where mobile money thrives. Fourth, no last-mile cash-out infrastructure. In most developing countries, banks have few branches. Telcos have tens of thousands of kiosks. Fifth, identity friction. Banks require formal documents and in-person verification. Telcos already perform government-mandated identity checks for SIM registration. Sixth, banks have little incentive to serve the unbanked. The unbanked are expensive and unprofitable under the traditional model. In contrast, telcos already serve these customers at massive scale and make money doing so. Section 3. The telco advantage, a distribution empire banks cannot match. A telco is not just a phone company. It is an identity provider, because SIM registration is identity verification. It is a payment network because airtime and mobile money are payments. It is a cash-in and cash-out institution. It is a state-regulated communications utility. It is a financial distribution channel touching every citizen. Many countries legally require SIM cards to be tied to verified national identification. This means telcos possess the strongest and most universal identity network on Earth. Telcoin's insight is simple. The easiest way to scale stablecoins is to plug them into this identity and distribution layer. Section 4. The liquidity lake, EUSD as the settlement core. At the heart of the system is a United States dollar-backed stablecoin pool, the liquidity lake. This lake is fed primarily from users in the United States and Canada through Telcoin Bank in Nebraska. Other global North remittance senders, and business payment corridors such as imports, freelancers, and cross-border small business payments. The lake's purpose is to act as a unified settlement layer from which funds can flow to any connected country. Telcoin Bank holds United States treasuries backing the EUSD float. Therefore, expanding the lake expands Telcoin's treasury portfolio. Every dollar held generates yield. Every corridor added increases liquidity, reduces slippage, and lowers costs. The incentive is structural. Grow global usage to grow the yield base. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. Tributaries. How telcos become the local bank. On the edges of the lake are telco-led mobile money systems. Each telco maintains a local fiat omnibus account, a customer mobile money ledger, identity and verification records, and cash-in and cash-out agents. When a user receives EUSD, a payment processor or foreign exchange partner converts it into local fiat. The telco ledger credits the customer, and the telco holds the corresponding fiat float. This float often ends up in short-term government securities, central bank money market instruments, or regulated mobile money trust accounts. Either way, the telco earns the yield, not the user. This mirrors the M-Pesa model across Africa, now extended with a global United States dollar rail. Section 6. The TEL incentive moat, why competitors cannot replicate this. Here is the strategic choke point. Telcos will not integrate the systems of Circle, Stripe, or Tether unless incentivized. Telcoin offers settlement rewards in TEL, liquidity routing incentives, ecosystem participation upside, and GSMA co-governance. No major stablecoin issuer offers revenue sharing or token incentives, and they cannot. Circle is corporate and is not tokenized. Stripe cannot issue a token because regulators would revolt. Tether keeps all profits. Banks cannot pay telcos for routing money. Telcoin's first mover advantage is not technical. It is political and incentive-driven. Once telcos are locked in, the network effects compound aggressively. Section 7. Architecture. The parallel banking system being built beneath our feet. This network has 3 layers. The first layer is the EUSD settlement core, the liquidity lake. It is backed by treasuries and managed by Telcoin Bank. The second layer is Polygon paired with the Telcoin Layer 1 chain, handling smart contract settlement, token routing, and on-chain transparency. The third layer is the telco endpoints, providing local fiat distribution through mobile money systems. Money flows quickly, cheaply, and continuously. It flows with strong identity guarantees and without reliance on commercial banks. This is a new banking stack, not a fintech app. Section 8. The Global United States Dollar Mobile Money Map, why the South will drive adoption. United States dollar mobile wallets already exist in Kenya, Ghana, Uganda, Tanzania, Zambia, Nigeria, through fintechs, the Philippines, Vietnam, Cambodia, Guatemala, El Salvador, Honduras, Nicaragua, and much of the Caribbean. These regions rely on the United States dollar as a hedge against inflation and currency instability. They are biologically predisposed to use a United States dollar stablecoin, not for speculation, but for survival. The liquidity lake grows fastest here. Section 9. Consequences. Telcos quietly become banks. If Telcoin succeeds, telcos evolve into de facto narrow banks, United States dollar custodians, foreign exchange remittance hubs, savings institutions, but only for themselves, gateways for cross-border commerce, and identity authorities in the new financial stack. Users get convenience. Telcos get yield. Banks get bypassed. The more float grows, the more power shifts from banks to telcos. Section 10. Strategic implications. A redrawn map of global finance. First, remittances collapse from 7% to below 1% fees. A multi-billion-dollar industry disappears. Second, banks lose deposits. Mobile money combined with United States dollar stablecoin becomes stronger than local checking accounts. Third, governments maintain control through telcos. Telcos are domestically anchored and politically compliant. Fourth, decentralized finance becomes invisible back-end infrastructure. Users never see the blockchain. They simply use their phone number. Fifth, a new class of cross-border small business commerce emerges. United States dollar liquidity is everywhere. Sixth, financial inclusion is achieved by accident, not through charity, but through incentives. Section 11. Conclusion, the new banks wear SIM cards, not suits. The next global financial network is being built quietly, not by fintech startups or global banks, but by telcos. They are the identity layer. They are the last-mile distribution layer. They are the liquidity aggregation layer. They are the regulatory compliant cash-out layer. Telcoin did not create this reality. It simply aligned incentives, infrastructure, and regulation to reveal it. Banks had the first century. Telcos will take the next.